Canada could be sitting on the biggest housing bubble of all time. That's according to one strategist who's warning that once it bursts, Canada could be thrown into a deeper recession than any have forecasted. Let's bring in Phillip Colmar. He's a managing partner and global strategist at MRB Partners. He's coming to us today from Belleville, Ontario. Phil, good to see you. Walk us through the big takeaway here of what you're saying.
Yeah. Okay. Well, thank you for having me. The key here is we've been monitoring it for some time, but the Canadian housing market it does have excessive house prices relative to income. So when you're looking at that big headline about a housing bubble, what you really want to do is compare house prices to incomes. And Canada for some time has been escalating on that front, particularly even before the pandemic. It was last decade. It had a cheap interest rate environment or low interest rate environment owing to really problems south of the border after their housing bust. They went through deleveraging, which meant they dampened down consumption and inflation, allowed interest rates to be very low. Bank of Canada followed suit, even though the crisis wasn't here. And that seduced a lot of home buyers into buying homes, using those interest rates to effectively buy homes, and house prices to incomes surged. And through the pandemic, we got it again and kicked it further up. So we do have pretty excessive house prices to incomes. And I'll turn it back, but certainly underneath the surface, when you're looking at a housing bubble, the things you really do worry about is when you not only have excessive home prices, but excessive leverage backing the whole system. And Canada kind of is really off the charts on that front, and that's really where the concern comes in. Is on the leverage to income ratios is way north of where the U.S. was at its peak. Makes the U.S. look somewhat prudent, actually. So it really has been seduced by low interest rates.
Is a bursting of the bubble inevitable, Phil?
Yeah, I would say it's pretty inevitable. It's pretty. I mean, when you're dealing with these kind of excesses, you're really hoping that home prices stay capped while incomes kind of grow for a long period of time, and hopefully interest rates don't rise. That's a hard thing for policymakers to orchestrate, particularly when we're dealing with greater inflationary dynamics and higher bond yields than we have in the past. And so, that has to occur for a number of years, given the extensive nature of the bubble that we have now. And so the things you'd want to look at, I wouldn't say it's necessarily imminent, but the things you do want to look at is if mortgage rates are going to rise again or unemployment starts to rise. Those are the things that really bring it home to roost. And we got a taste of that last year. A lot of people before the pandemic had been switching over to floating. They got nailed on the floating when floating started to rise. And then at best, you tend to have a 5-year mortgage rate being reset. So after a year, every year you get call it 20% of it gets reset. So it's not the U.S. where you get a 30-year fixed. So mortgage burdens do become quite astronomical. Affordability is bad right now, but debt servicing of those mortgages is pretty excessive. And so last year we saw when mortgage rates went up, we saw about a 10 to 15% haircut on house prices across the nation. But I think that's the taste of what's to come. Mortgage rates have started to rise again, largely due to the U.S., but keep an eye on there. And if unemployment rises, we get to the next recession, then we're going to see a down leg for sure.
Yeah. Any possible timeline you're looking at here?
Yeah, the thing that I was talking about and bringing it home to roost is I think people made a miscalculated bet on the U.S. about it going into imminent recession, and that brought down bond yields. And U.S. rates are in some way, shape, or form tied to United States rates. And so when people unwound their recession bets or their imminent recession bets, we started to see new highs in the 10-year Treasury south of the border. But it drove up mortgage rates here, or bond yields here, which drove up mortgage rates here. And that's the risk point. So that brought it home to roost, where if that keeps going, then look for a very near-term bursting, so to speak, of the bubble. Otherwise, we're looking towards a recession. That's probably, you might get another year out of it, but then we're looking into the next recession. And of course, Canada, although I think the U.S. would go through a mild recession, given its household sector is in good shape after going through a bust and deleveraging, Canada is going to face sort of what the U.S. did, a very deep deleveraging cycle, quite a pronounced recession. And unfortunately, the currency will take it on the chin too. So you'll end up with a lower Canadian dollar as part of the reflationary mechanism.
Phillip Colmar joining us from Belleville, managing partner, global strategist at MRB Partners. Thanks for taking a bit of time for CTV today on this story. Much appreciated.
No, thank you for having me.